You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play.
Gold, crude oil, corn, soybeans, and more. With so many tradable products, the futures options market can be an intimidating place. How can you possibly keep track of the latest trading developments across so many different products? Don't worry, we've got you covered. Welcome to This Week in Futures Options, the program designed to help active futures options traders stay on top of this ever-changing marketplace. Each week, we'll break down the top trades, hot products, volatility explosions, and much more. This Week in Futures Options streams live, so be sure to check out our live stream via the Mixlr app. That's MIXLR. Or join our live chat room at mixlr.com/options-insider. Whether you're an experienced veteran or a newcomer looking to separate the wheat from the lean hogs, This Week in Futures Options has the information you can't find anywhere else. This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. And now, get ready to break down the latest futures options trading activity. It's time for This Week in Futures Options.
All right, everybody, that music means we are back. It is time to rock out in the world of futures options. Yes, it is time once again. For TWIFO, my name, of course, Mark Longo from the Options Insider Radio Network. Your home now for 19 plus years of options goodness. And of course, if you want a little extra sprinkled on top, the optionsinsider.com/pro. Awesome pro Q&As. We went deep into silver and the 10-year and a whole bunch of other futures and futures options related products on this week's pro Q&A. Check it out. The optionsinsider.com/pro is the place to go to learn more as we learn who's joining us in the old CME Group hot seat this week. I'm pleased to welcome back on our old pal, Miss Energy herself, none other than Carley Garner from DeCarley Trading. Carley, welcome back to TWIFO, madam.
Thank you, Mark. As a pleasure. It's always a pleasure.
You like that, Miss Energy? Anyone ever called you that before?
That one's new. I've been called the Queen of Crude, which you can take two different ways, and I'm not sure I like that. I think I like your version better.
I think mine rolls off the tongue a little bit better.
It does.
You want to go home and say, Mom, they're calling me the Queen of Crude.
Yeah, it's not impressive to parents.
Sounds a little bit different. So instead, let's mix it up, listeners, as we head on into the Movers and Shakers report.
It's time to find out what's rallying on the light side and falling to the dark side at CME Group this week. It's time for the Movers and Shakers report.
All right, everybody, welcome to the Movers and Shakers report, the portion of the show where we break down everything, lighting it up to the light side and to the dark side over there at CME Group this week. And if you look at our full chart that we put out ahead of the show, you will see that we are biased towards the red this week, but not overwhelmingly so. I would say it's about 60-40, maybe 65-35 red over green out there. But we do have the largest percentage mover this week is to the dark side. Can you take a guess exactly what that might be, listeners? But Carley is our guest. She does get pride of place. Where do you want to start this week, madam? To the light side or to the dark side?
I'm leaning dark side this time.
Yes, all right, there's a little bit more of that to be found this week, so have at it, madam. The floor is yours.
Okay, sounds good. So we're going to start with number 5, real estate, down 3.24%. Number 4 is gold, down 3.43%. And this is kind of interesting because there's no shortage of volatility in gold. It has been a really wild year. And the worst part about it is I'm not sure anybody's winning, right? The shorts got wiped out on the upside. Now the bulls are getting wiped out on the downside. Number 3 is natural gas, down 4.83%. This might be a surprise to some people, given what's going on in crude oil, but reality is we have way too much natural gas. Not enough crude, but too much gas. Number 2 is silver, down 5.18%. And number 1 is oats, which is down 7.5%. And that's kind of interesting, I'm sure, to most people. There's a saying in this business, and it's Oats Knows. So while the other grains are looking pretty good today, maybe oats is telling us something different. So be careful out there if you're a grain bull.
Interesting. Oats Knows. You know, that guy on the Quaker Oats box, he looks kind of wise. I think I might trust him for some market directions, a market sentiment. What do you think? Oats, the leading indicator, Liz. I bet you didn't have that on your bingo card this week. All right, to the light side we go, madam.
Alrighty, starting number 5. It's the Nikkei, up 1.44%. And actually, I'm going to be 100% honest. It's Nikkei/yen. So I'm not sure if that's Nikkei price in yen.
Yeah, that's the Nikkei denominated in yen. It's confusing. I get it.
I never trade. I've been in this business for a long time. I've never traded that one. So I'm learning something.
You're too busy slinging oats to sling the Nikkei, you know?
Exactly. So number 4 is feeder cattle, up 2.3%. And honestly, this is a win for cattle producers because with everything else melting down, the way that cattle's behaving is actually very impressive. Number 3 is materials sector, up 4.14%. And at number 2, we've got soybean oil, up 4.27%. If you're trading soybean oil or soybeans or literally anything else on the board, you're trading oil. So oil is probably the biggest contributor to that soybean oil being on the board. And number 1 is the energy sector, up 5%.
I wonder why that is. Why would energy be up 5% right now? Just absolutely did not have that on my bingo card at all. But you know what? We'll get there in a second, listeners. But first, let's kick things off in another E-complex that I think a lot of you are wringing your hands over right now. It's the equities. Here we go.
It's time to explore the volatility swings, skew changes, and hot options trades in your favorite indices. It's time to talk equities.
All right, listeners, you're going to go over to our page, cmegroup.com/TWIFO. Once you're logged in, I should say, you're going to go down 4 slots to equity indexes under the asset class. Then we'll kick it off in the S&P. That is the big dog. A lot of people are focusing their trading on right now. But Carley, another wild Thursday, another blood red Thursday. We're kind of just following the playbook now. Rally early in the week, cut the legs out second half of the week. What's catching your eye in the world of equities right now?
Right. Well, you said it right there. When people are nervous about being extra long going into the weekend, that's when you know things are not going well. If people are liquidating before we get to Friday because we don't know what's going to happen over the weekend, not a bullish sign for equities. I'm actually really, really impressed at how well the indices have held up. I mean, I know NASDAQ and S&P are down a little bit, but in the overall scheme of things, they haven't given back that much of the massive rally that we saw since Liberation Day last year. So I think this is kind of a win if you're an equity bull. That said, I'm not sure it's going to last. We have to kind of hope for the best, but prepare for the worst. If you look at the chart, it looks almost identical to how it did last year. The VIX was elevated in March. We had these, several attempts at rallies sold into, but the overall selling was pretty orderly and tame until it wasn't. We all remember what happened in early April. I don't know if there's going to be a similar catalyst or, if there's going to be something that shakes things up in addition to the crazy war headlines. But if we are repeating last year's pattern, which so far almost to a T we are, there's probably a little more pain in the tape. So be very careful. Hopefully you have some powder dry so that you can take advantage of a big dip if we get it.
And obviously one of the big narratives of the year in the equities has been this rotation out of large caps into small caps. Small caps have been flirting with green to red on the year. I think it depends on the day you're looking at where they're hanging out right now with today's sell-off. And we're seeing most of the major equity indices off. S&P off nearly 1.5% today, listeners. NASDAQ off about 2% today. So they are coming for the equities today. And with this sell-off, I think about 1.5% in small caps as well. And we are seeing small caps tilting towards the red again for the year as well. What are your thoughts on this rotation, or is it just abandoned ship on all of it right now, Carley?
Well, I think we started rotation, and the rotation is kind of what's been helping a lot of the indices out. Like we've rotated, a lot of people have rotated out of the Mag 7 and into other things. But I just see the writing on the wall, and it doesn't look positive for me. To me, I should say. One thing I'll mention is the VIX is elevated, and it's been elevated for a while, and it's as we've just mentioned, we haven't seen any massive selling in the stock indices. But with the VIX this elevated, it makes me nervous. And the reason I say that is I talk to retail traders for a living, and I'm pretty confident. I don't know 100% for sure. I haven't been looking at people's statements, but just from my conversations, I feel there's a pretty good chance that we've got a lot of leverage under the market that is unaccounted for. And what I mean by that is a lot of people that have been consistently selling puts in the S&P because that strategy has worked like a charm. And I'm not sure they're going to know what to do when it stops working. So if there's a lot of short puts under there, which I think there are, the VIX probably has a little further upside. And I also believe there's a lot of people with triple leveraged ETFs and those sorts of things that aren't going to know how to manage them if things get a little bit crazy. So I'm not looking for the world to end, but I also believe there's a little bit of danger out there as some of the leverage works itself out.
Well, looks like we just broke through 6,500 in the S&P in the wrong direction for the bulls. And this was a level that was very active on the show last week. We had Dan Grams on the show last week, and we were north of it at the time, but we were selling off during the show last week as well. Again, very similar playbook to this week. And we were talking about how a lot of people last week on the show have been very active in the 6,500 puts all week, the ones that were expiring on Friday. So they had about a little over a day to go on the show. And of course, as we were doing the show last week, the market actually turned around and ended up getting to green, at least by the time the show was over, which was a wild move in and of itself. So we joked on the show. We said, wow, that kind of puts the nail in the coffin of these 6,500 puts with only a day to go. And lo and behold, Friday comes along and they cut the legs out of the market again, and the S&P ended up closing below 6,500. So all those folks who were tilting at 6,500 puts last week expiring on Friday, congrats to them because they ended up working out. Maybe not as aggressively as they thought, but certainly looked a heck of a lot better on Friday's close than they did going into the close on Thursday. This week, we're seeing a similar flow of paper. 6,500 puts with 1 day to go have been pretty active all week long. Almost 9,000 changing hands today, which again, we just broke through that strike. We're pretty close to it, so I have to imagine that number is probably going to go up. We saw about 9,000 trading on Monday and then 3,000 on Tuesday, about 5,000 yesterday. So again, about 26,000 of these 6,500 puts have traded this week. And if you want even more, 6,400 puts expiring tomorrow, going up 33,000 times. Doesn't seem like related flow with the possible exception of Monday. Could have gone up as a bit of a vertical on Monday. But there you go, listeners. A lot of people tilting at puts this week. And if you want a little bit more time to go and maybe a little bit farther out of the money strike, looks like a lot of action in June, 6,000 puts today, particularly going up about 2,500 times today. Looks like for prices around $120. So there you go, listeners. A lot more duration. And we're talking 0 day and 1 day to go. Now we're going all the way out to June and all the way down to 6,000. Carley was just talking about some leverage in the market. Would you sell that put for $120? Would you draw that line in the sand there, or would you be more of a buyer out there? And if you want a little bit funkier action out there, we also saw a June, again, a lot of action in June, 6,200, 5,800, 5,400 put fly going up about 1,000 times today for $30.75. So a lot of different action, a lot of it to the downside. It's kind of just a pick your poison of how far out in duration and how far down the strike chain you actually want to go. I don't know, Carley, June 6,000 puts for $120. Is that what you're talking about? The sneaky hidden leverage in the market, madam?
I am. To be honest, obviously, I don't think the odds of us seeing 6,000 or, several hundred points below in a couple of days is pretty slim. But the problem is there are a lot of people that I talk to that are selling these options that expire in a day or two, and they're picking up $50 to $100, and it's great and it's going to work most of the time. But there will be one day, and I don't know when it is. I wish I did. There's going to be a day that um, that strategy doesn't work. Kind of like if I think everybody remembers what happened in silver. There was an entire cottage industry of traders that sold silver calls on every rally, and it paid off for a decade. And then one day it stopped paying off, and it was a very, very expensive position to have in the wrong place at the wrong time. So I suspect we're probably due for something like that to happen in the S&P. I hope I'm wrong, but that's how anytime somebody, especially a large group of people, are kind of doing the same thing, and they start thinking they've figured out the market and they've figured out some sort of I'm not going to say easy, but some sort of a strategy that's working. I'll just use the word working. The market generally, it generally changes things up and reminds us that the market's bigger than we are, and there is risk in everything. Even selling options 300, 400, 500 points out of the money with expiring tomorrow. There will one day would be a lot of risk to holding those.
Well, they don't call her the queen of crude for nothing, so let's get there now. A little bit of the old energy.
It's time to tap into the deep options well of black gold, Texas tea, nat gas, and more. It's time to talk energy.
All right, everybody. Welcome to the explosive world of energy. Pop out of the equity indexes asset class. You're going to go up one slot to energy. Then top of the list product family, we're going to go crude oil. And then, of course, our old pal WTI. WTI hanging out as we're coming in to start this segment, a little bit shy of 95, 94 and a half. Puts it down about 3 3/4 or almost 4% on the week. You go back to the end of our show last week, obviously a little bit of a different story. But we have been kind of vacillating around or near this 100 strike for a while. Markets maybe getting a little bit used to these vol levels out here. I mean, we were talking last week about vol in WTI that was exceeding nat gas, which again, a very rare thing out there. But right now, only in air quotes, only about 650,000 contracts on the tape. I say only because we saw a lot more obviously going up in the first few weeks of this conflict when we were blowing through the power strike and things were trading fast and furious out there. 650,000 contracts, that's a decently active week. Of course, it's more than a usual week, but it's not obviously blowing the doors off out there. So again, maybe crude traders starting to settle into this mode of higher vol and inflated price levels, at least for now, out here in all things crude. But Carley, you are the queen of crude. What is catching your eye out there this week?
Well, I mean, I think it's fair to say that crude oil is the new gold and silver, right? We're getting a lot of speculators jumping in on the trend, and that's to be expected with all the headlines that are coming out. Nobody has a crystal ball. No one can see what happens in the future, but I'm paying a lot of attention to what happened in 2022 when Russia invaded Ukraine and how the market behaved then. I know the circumstances are different, but the reality is markets are moved by people, and people behave the same way in similar circumstances. We're very habitual. So when I look at 2022, crude oil had a massive spike up, pretty sudden, up to the 130-ish area. And then we pulled back sharply, almost identical to what we've seen in the last couple of weeks. And then crude spent the next month and a half, 2 months, putting together a pretty reasonable, civilized rally to attempt to retest those highs, and we failed. And I think we're probably going to get something very similar this time. So with that said, I do think crude oil probably has a pretty good shot at grinding its way up to 105, 110, maybe even 115 if we get some sort of headline that jars the markets or something, exciting happens over the weekend. But in any case, I think that this rally is going to end the same way any other crude rally has ended over the last 25 years, and that's with a bunch of selling basically at the end. This is probably going to be anywhere over 100. It's probably going to be a better sell than a buy. The trick is to make sure you don't lose your shirt while you're trying to figure it out, and you have to have chips on the table to benefit. So it's going to be tricky. There's no free lunches. Maybe even stick to micro crude oil futures and options and just keep it real simple. You don't want to have to sell a kidney or anything to pay for your futures account losses.
It all seems to end in tears at the end of the day, Miss Carley. So we'll see what we can do to avoid that on the show today here, listeners. Like we said, a decently active week, not explosive here in WTI. Of that roughly 650,000 contracts, a little over a third, about 35% going up in the May contract that has 21 days to go. So we will hang out there. By the way, what is the vol in May WTI? I might be asking. Threatening triple digits yet again, 96.5, up 7 1/3 points just this week. If you go to some of the narrow dated contracts that have 5 and 8 days to go, they are over triple digit vol. So again, just absolutely ridiculous vol levels out here in crude oil right now. In terms of skew, we are seeing a bid to the calls, but it has come back to earth a little bit. They were 5.4% bid last week. This week, 3.5% bid. So all things considered, not that crazy, especially considering we're starting at a baseline vol of 100 almost. What's 3.5 points on top of that? Not much. The puts about 5% discounted. So right now, not a lot of love for the puts. Not a ton of love for the calls. We're kind of, I would say, close to a little bit of an equilibrium out here. But again, that could change on a dime depending on the headlines out here. And if you're saying to yourself, what is the hot option in the world of crude and indeed WTI this week? It looks like it's the May pars. The May 100 calls have been lighting up the tape to the tune of almost 19,000 contracts this week. Active pretty much every day this week. Looks like yesterday was the big day. 9,000 yesterday, 5,000 on Monday, about 1,000 on Tuesday, and 3,500 today. By the way, if you're wondering, May pars right now, $6.51, what they were trading for this morning. So maybe that floats your boat out there, listeners. You think we're going to get back to the par strike? You're willing to pay $6.50, or maybe you want to overwrite those. You do have 21 days to go, which doesn't sound like a lot, but in this market where we're changing literally minute by minute and hour by hour, 21 days is actually an eternity out there. So interesting stuff out here in the May pars. If you wanted something, let's say, a little bit more to the downside and a little bit longer term, we're also seeing action in June puts. We saw the June 70 and the 75 puts also lighting it up this week. In fact, the June 70 puts are the number 2 most active contract in WTI this week, going up 13,500 times this week. The big day was Monday with about 8,300 going up on Monday. The rest of the week kind of putting together roughly the other half of that flow. But there you go, listeners. Maybe some folks looking for a little bit of downside, a little bit of reversion to some strike levels we were trading at not that long ago. I did a little bit of digging before the show to see what these were going for. The big day for those June 70 puts was on Monday, and on Monday they were trading for about $2.60. So again, up to you whether you want to write that line in the sand or you want to be a buyer of those puts. We also saw if that's maybe a little bit too far out of the money for you or maybe too much outlay for you. How about the June 75-65 put spread? That was also trading pretty actively on Tuesday for a little over $2, about $2.14. So a couple of different ways for you to play a little bit longer term downside. So Carley, in the near term, we got May pars lighting it up, and a little bit longer term, we got some June downside. Any of that float your boat?
Well, I mean, I think it's obvious that the options are overpriced at this particular time for good reason. There's lots of volatility. So what I've been encouraging our clients and followers to do is, if they really have an itching to get involved in crude oil, maybe consider trading a different market, a market that's related to crude, but doesn't have the expensive options. So for example, the Japanese yen is extremely low in volatility at this particular time. The options are wildly cheap, and the yen has been suffering at the hands of higher crude oil. As crude oil goes up, the yen kind of sinks a little bit lower. So what we've been doing is just buying some yen calls. They're really, really cheap. You don't have to go that far out of the money to get an option that it has 3 or so months to expiration, and you can, get them for $600, $700, $800 and just let it go. If crude oil, something in crude oil changes, maybe the Strait of Hormuz opens or whatever the case, and crude oil turns the corner pretty sharply, those yen calls will be in place to make some money. You're not going to, you're not going to probably not like being short crude futures or anything, but it's a way to play and, keep yourself interested without risking too much.
I like that. If you're a little bit too spooked to play WTI, and who can blame you, triple digit vol, maybe the yen is the way to go, listeners. And Carley, since you are the queen of energy, let's put it, as opposed to the queen of crude, you always like talking a little nat gas. There's been some action out there as well. Should we head there next, madam?
Sounds good to me.
All right, to nat gas we go, listeners. Keep it in energy, pop out of crude. You're going to go down 2 slots in the product family to nat gas. As you come in, you'll see nat gas back below that 3 handle, but just ever so slightly, 293, off 13 cents, or about 4.25%. Just since Monday. Obviously, these charts show you, obviously, since the beginning of the week. If you go back to the end of our show last week, it's off nearly 5%, about 4.8%, listeners. And is it an active week? Again, I think nat gas starting to get a little bit used to some of these shocks out there. Obviously, we saw a pretty big shock last week when we saw the bombing of one of those big LNG fields over there. Again, LNG also an interesting product. It is very much locked by region. We have U.S. nat gas, and we have, the international variants and flavors out there as well. But there has been a lot of focus out here on nat gas. Carley, what is catching your eye in your beloved Widowmaker, Matt?
Well, we've got the April options going off the board here, and the futures are going to be following suit very, very shortly. So I do suspect that we probably get a down move in the direction of the trend, which is lower. A lot of people are kind of having a hard time grasping how our natural gas prices are under $3 when overseas they're seeing things spike pretty dramatically. But as you mentioned, geography helps us, and the U.S. makes a lot of mistakes. But the one thing we did right was energy independence, or at least working towards that goal. So all is well in natural gas. In fact, I think we have too much of it. And if oil producers continue to hit the gas with these high prices, I know it's oil production takes a little time to come online, but we've got offshore drills in California that have been sitting dormant for decades coming back online. There's all kinds of things happening. The smaller drillers are trying to take advantage of these prices, and that's going to create even more natural gas. So I would suspect that we have a little bit of weakness here before we find any footing. So puts are pretty cheap. I think it's probably a good idea to have some puts in place. I wouldn't swing for the fence or anything, but buy something cheap, maybe in the 260 or under strike prices, and let them work, see what happens. I do believe we probably get down to 250, 240. That's where the monthly and weekly chart support comes in. But at some point, if we do see those prices, going to be a really good opportunity for the bulls to dig in and get aggressive. So nibble on the downside if you want to play, but the big moves will probably be from the upside, but from lower levels.
Carley, I have to ask you, you're my resident nat gas historian here. I'm not used to pulling up nat gas and seeing it trading pretty much half the vol of WTI. Usually it's the other way around. Nat gas is threatening triple digits, and WTI is maybe somewhere in the 40s. Literally the polar opposite right now. We have nat gas, or I should say WTI, literally in triple digits, and nat gas hanging out at the mid to high 50s. Off the top of your head, can you think of the last time we saw something like this where nat gas was pretty much half the vol level of WTI? Maybe April of 2020?
That sounds about right. I would say, I'm just kind of speculating here, but if you recall, a couple of months ago, we had that massive natural gas spike towards $8. It was very sudden. I think it wiped out a lot of option sellers, probably wiped out a lot of short futures traders. I'm sure a lot of, most people assume that stop orders are guaranteed, but they're not. In really fast and unruly markets, those stops can sometimes get hopped over. Maybe it's a gap over the weekend, or maybe it's just a fast moving market and it can't get filled in time to within a price window that the exchange sets. So I suspect there was a lot of people that felt a lot of pain on that rally, and they probably have just moved on to other markets. So I think it's probably a situation where speculators got burnt and they moved on to different markets and they're not willing to touch it. So I think that's probably a big part of it. I suspect they will eventually get burned in crude oil as well. So they're running out of markets. I mean, they started with gold and silver. There's been some havoc on both sides of the tape there. I think there's going to be in crude oil. We already talked about natural gas. So I know it looks like there's probably a lot of people making a lot of money because markets are moving, but my best guess is I think people are mostly losing money. So I think this is really bad for the industry to see this kind of volatility. So hopefully it calms down.
Like we said, Carly, it all ends in tears eventually. Let's see what's cooking out here in nat gas this week. Like we said, not the most explosive week, pun intended, we've seen from a nat gas volume perspective. 350-odd thousand contracts on the tape. The big dog looks like it's out in May. That's where about 46% of the volume has gone up this week. That has 32 days to go. Again, May vol, a 59, off a little over 4 points. So you're talking nearly half of what the commensurate May vol is in WTI. Again, absolutely wild. If you're talking skew, last week the put's 4.8% cheap this week, 6.8% cheap. So put's getting cheaper. Calls 6.1% bid last week. This week, 9% bid. So maybe we're starting to hit a little bit of an inflection point here. I guess we shall see what the flow tells us. And looks like the flow is pretty even. Carly was talking about 2.5 to the downside. We're seeing action on the May 3/2 and the 2/2. So folks liking both of those. Looks like pretty much equally. About 14,600 of the May 3/2 is technically the big dog this week. The big day, about half of that going up on Monday, actually. Almost 7,000 going up on Monday. A little over 2,000 each on Tuesday and Wednesday, and about 3,000 today. The OI in that strike is about 20,000. And then we have the 2/2 puts again in May, going up about 14,300 times. So pretty close to neck and neck with the 3/2 calls. Those trading, again, pretty evenly all week long, actually. Monday, Tuesday, and Wednesday, all right around 4,000 contracts today, about 1,700. The OI on that strike, a lot higher, about 40,000 contracts open on that strike. So maybe 2/2, 3/2 strangle. Maybe you like that, listeners. Maybe you like doing a collar or a risk reversal there. Or maybe you like just loading up on one or both. If you like something a little bit closer to home, how about the 3/4 calls? Those have gone up about 11,200 times this week. The big day for those actually today, about 4,600 changing hands today against an OI of about almost 19,000. So a little bit of upside, a smattering of downside, lighting it up out here in a kind of light week in all things nat gas. Carly, we did equities, we did energy. What else, I should say, is lighting up your tape out here this week?
Do you have any interest in doing the metals?
Metals, what are those? Well, I guess we can make that happen. To the metals we go.
Werewolves beware. It's time to explore the options activity in silver, gold, and other shiny things. It's time to talk metals.
All right, everybody, you know where to go. You used to live in the metals complex not that long ago, listeners. Pop out of energy and go all the way down to the bottom of our asset class list to metals. And we're going to go into precious because I think that is a very interesting story out here. Well, let's kick it off in the king of the precious, which is gold, listeners. And gold having about an average week out here right now, putting up about 250,000 contracts. That's what we've come to expect on, again, in a given week out here in gold. Even though the sell-off continuing out here off 185 handles or a little over 4% since the start of the week, hanging out a little bit north of the 4,400 strike. If you go back to the end of our show last week, it's off about 3.5%. But Carly, you mentioned a couple of things that caught my attention at the top of the show. First off, you're right. We couldn't stop talking about metals the first few months of this year. All of our listeners turned into amateur metallurgists here on the network. They couldn't get enough silver and gold. And once the Iran conflict, that worm turned very quickly and everyone's all in on all things energy and vol and everything else that they're focusing on right now. And the flip side of that too, also, I mentioned this with Dan on the show last week as well. It used to be conflict in the Middle East. You know, you pull out the playbook, and that playbook had a couple of obvious moves in it. The first one was buy crude, because that usually tends to work out, and that's worked out in this one. The other side of that was usually buy a nice flight to quality asset like gold, and yet we are not seeing that. In fact, we are seeing the exact opposite. They have been coming for gold for quite a bit of this conflict. So what are your thoughts on this evolution we're seeing here in the shiny stuff, Matt?
Well, you're absolutely right. And I have a couple theories, and I've been talking about this for a little while. Somewhere along the line, gold turned into a risk asset. It turned into basically just another stock in your portfolio. So I think a lot of people were buying gold thinking they were diversifying and they were hedging their stock market volatility. And in fact, if you look at a monthly chart or even a weekly chart, you can see for the last handful of years, gold and stocks have been moving in lockstep as if they're the same asset. So gold has become a risk asset. That'll probably change at some point as traders move their capital around to different markets. But for the time being, it's a risk asset, and it's behaving just like that. And I'll also mention, I think markets are forward looking. Just because you or I or most people did not have any idea that a war was going to break out in Iran and the U.S. would be the one initiating, somebody knew or somebody suspected, because you could see the gold market move well before the bombs dropped. And we actually, I believe, last year we saw something similar. So, the market was telling us something was going to happen, and we just didn't know what it was, obviously. And now we do. So I think what I'm trying to say is I think it's kind of buy the rumor, sell the fact. I think a lot of that was already priced in, and failure for gold to continue higher on the actual news was really a reason to liquidate. And lastly, gold has been a massive winner for a lot of people. And when things hit the fan, they tend to sell their winners to raise cash to either meet margin calls or to buy more stocks, buy the dip if that's what they're trying to do. So I think it's really a liquidity issue, and I think it will continue to be. I suspect gold really, really, really needs to hold 4,100. If it drops below 4,100, that's going to be very bad news for the bears. That's the 200-day moving average. It's also kind of a line in the sand between bull and bear market if you look at the highs from a couple years ago. So pay attention to 4,100. What happens there matters.
There you go, listeners. 4,100 is the make or break level out here for gold. Like we said, a pretty average week from a volume perspective. Of that 250,000 contracts, looks like a little over a third going up in the May expiration cycle. Has about 32 days to go. If you're wondering what is May vol in gold, it's at about a 38.5, up 11.5 points, which again, nearly a 40 handle in gold vol. I know we got much higher in all of the madness, but still, anyone who's been watching gold or the metals for any length of time knows gold usually hangs out somewhere in the mid-teens, or if not lower. So to see it threatening a 40 is still kind of wild to me. In terms of skew, last week, the puts were where all the action was. Nobody wanted a call, which again, kind of the inverse of what we've come to expect out here in the shiny stuff. The puts 10% bid last week. This week, 3.9% bid, so coming in 6 points. The calls last week, 5.2% discounted. This week, flat. So the call wing is kind of flat. So that is kind of interesting. And looks like a lot of the action we're seeing out here this week has been in the May 52 halves in particular. They were lighting it up about 9,000 times. In fact, looks like a lot of this flow was on Monday. They traded 4,300 times on Monday. And looks like we have a little bit of call fly action going up on Monday, which is why May is kind of dominating the tape this week. On Monday, we had the 5,000, 52 half, 5,500 call fly going up. Looks like about 2,300 by about a little over 4,000 times. So interesting strike. So maybe if you're looking for a little bit of upside and you don't want to shell out too much for it, but you think maybe we can get back above the 5,000 handle by May expiration, maybe you like this. Looks like it went up for an average price of about $11.70. So I suppose if you want a little bit of upside, maybe that strike floats your boat. Carley, what do you think about a call fly in gold in May starting around the 5,000 strike? Or do you think 5,000, we're done with that for now?
Yeah, I'm not sure we see prices that high. So the numbers I'm looking at, I already mentioned 4,100 on the downside. Pretty good resistance is 4,700. That's the previous uptrend line. We're now below that level, so it's going to act as resistance on the way up. It was previously support. So I'm not sure we get above 4,700. If we do, there's a lot of headwinds. 4,800, which is a quicker trend line, and then obviously moving averages have crossed over. Anything is possible. We've learned that in gold over the last 2 months. Literally anything is possible. I mean, it's crazy because today we're down $170, $180. Yeah, 173 at the moment. And I've been doing this for a while, and I know I can confidently say I believe there's been multiple years where we don't move that much in a year, and we're doing it in hours. So I think butterfly is probably a pretty good way to play it. So that way, at least you have limited risk, and you could, place your money and see what happens.
You know what seems to be happening, Carley, is that nobody cares about silver anymore. Silver not lighting up the tape. It wasn't that long ago, Carley. Silver was doing 2x the volume of gold, and all anybody could talk about was silver, Carley. Coming into the show this week, silver shy of the 70 handle, right around 67.80, selling off nearly $2 or about 2.7%. This week, obviously, you go back to the end of our show last week, and we have silver off over 5, about 5.2%. It's our number 2 dark side mover this week. But you know what? No one can be bothered to trade the options, Carley. Only 15,600. That's light for a normal week in silver, let alone a week where we're selling off and silver is coming off the peak, dare I say it, of its popularity. So apparently, Carley, nobody cares about silver anymore. What do you think?
Well, I have had that. I've had the opinion of basically just paper trading silver or watching it in my head and not actually participating in it for a couple of decades now. And the reason being, it is literally one of the toughest markets on the board. I think it maybe is the toughest market on the board to actually pull money out of. And I suspect a lot of people learned that lesson over the last couple of months. So flash in the pan, and I'm, I know there, if anyone spends any time on X, I think there's a kind of a consensus that this is a dip and we're going back up, but I'm not sure that's the case. 2011, we saw a very similar topping action, although not this wild. And, once speculators get burned, they tend to walk away. And I think that's probably what we're going to see. And if that's the case, probably looking at $40 silver here in the next couple of months is my best guess.
And I was talking to one of our resident silver bulls. He's been the longest running silver bull I know, well over a decade. He's been long silver, and he finally bailed on it towards the end of last year, right around the 40 handle. Of course, we saw it obviously get much higher. I've been talking to him recently about what levels he would think about maybe selling some puts to try to get back in. You mentioned the 40 handle. Is that a level you would think about selling some puts, or do you think we have more to go, or have you washed your hands of silver completely, Carley?
Well, I haven't pulled silver off my quote board, but I highly doubt I would execute a trade in it willingly. So someone would really have to coerce me to do that. But
gun to your head, where would you sell the silver puts?
Yeah, but I mean, I wouldn't. As far as selling puts, this is a market that, I probably wouldn't consider doing that unless we were like in the 30s. So much, much lower is where I might start doing that sort of thing.
And have you seen, just anecdotally from all the customers over there at DeCarley, have they shifted away from the metals, at least for right now? Are they all in on energy? The volume numbers seem to be telling us that.
Yeah, that's exactly what we're seeing. Very few people are dabbling in gold and silver. When people get burned, they tend to just take those markets off their list and go and forget about them. And I suspect that's going to be the reality for a long time. So we probably won't see what we saw in metals again until the next cycle, and that might be a decade.
Well, the reality is we are coming up against it here on the show, but we have time for one more complex. So, Carley, you are our guest. You get to choose. Where should we wrap up the show this week?
The grains.
Oh, the grains. All right, to the ags we go, listeners.
It's time to get our hands dirty exploring the latest options, trades, and trends in corn, wheat, soybeans, and more. It's time to talk ags.
All right, listeners, pop out of the metals, which is all the way at the bottom of that list, and you're going to go all the way to the top. It is an alpha order list, after all, to the ags. Then we're going to hang out in grains and oil seeds. We were joking about oats at the top of the show. Oats Knows. Oats doesn't know any options volume, though, so I don't think we're going to hang our hat in oats. But, Carley, where should we hang our hat in the ags this week?
I have my eye on corn. I think that's pretty interesting at this point.
All right, to the big dog of the ags complex we go. We haven't talked corn on the show in quite some time, so always nice to mix it up. Corn hanging out 466 1/4 in that front future, up about 3/4 of a point, or about a little over 1/10% out here. this week. Volume-wise, though, corn making up for a little bit of lost time. Usually we see corn somewhere around 400, 450, already well north of that, 532,000 contracts. So I guess everyone who's bored of trading gold and silver is all out here trading corn this week, listeners. And of that, over 500,000 contracts, little under a third, about 30%, going up in the May contract that has about 29 days to go. If you're wondering, what is corn vol? Corn vol right now in May is about a 26, up about half a point. So that gives you some frame of reference. We were talking about nat gas in the 50s, WTI in the triple digit almost vol. Obviously, equity vol hanging out around the mid 20s right now, and corn vol slotting in right around that same level. So Carley, what's catching your eye in the king of the ags this week?
Well, the great thing about corn and wheat, particularly, is the options are pretty cheap. So it's not a place you really want to be habitually selling premium, but it's a really great way to play the war. Again, this is a way to maybe play crude oil without playing crude oil. If you think crude oil is going higher, corn's probably going to go higher. If you think crude oil is going lower, corn's probably going to follow. So you can buy some really cheap premium on both sides of the market, depending on what your view is on the war and oil, and not lose your shirt. So you can have a little fun, maybe make a little money, but if not, you're not going to ruin your life.
Let's see if anyone's ruining their lives this week, listeners. Like we said, May is where the action is, and it's well, before we get there, let's look at the skew really quickly. The puts last week, 5.6% bid. This week, they flipped completely the other way. They are 7.8% discounted. So interesting little switcheroo here in the skew. The calls last week, 2.7% discounted. This week, 6.5% bid. So the skew has entirely flipped the other way, which is kind of wild. We don't see that very often. The puts are now cheap and the calls are now bid. So interesting stuff out there. I guess if you were looking to put on some corn collars, then looking a lot better this week than last week. And looks like leading the dance out here in corn this week are the May 450 puts, so about $16 out of the money puts. They've changed hands about 22,000 times this week. The big day was Monday, a little over 14,000. In fact, looks like about 14,000 of the 440 puts as well. So it looks like a vertical went up on Monday, a little over 14,000 times, opening on both legs, by the way. And then both of them kind of trading pretty actively the rest of the week, but not quite 1-to-1. So it looks like, again, 22,000 total of the 4.5 puts have traded and a little under 20,000 of the 440 puts. So if you wanted a little bit of May downside, then perhaps you like that at 450, 440 put vertical. I don't have prices here, but you can go dig it up over there on the old TWIFO page. And then behind that, if you want a little bit of upside, how about, we've got kind of a close battle here for number 3. We got the 550s in September actually taking it. Those have 150 days to go with about 16,000 contracts this week. And then we have the pars in May going up almost 16,000 times as well. Looks like the big day for them was also Monday. So Monday, the hot day for corn this week. Looks like we have another vertical going up on the call side as well. Looks like it was the 480 500. So there is a possibility of maybe we've got somebody working 2 verticals, so a little bit of an iron condor maybe going up. Size is different, though. We got about 14,000 of the put vertical versus about half that, about 7,500 of the 480 500 vertical on Monday. And those have traded pretty close to neck and neck all week. So interesting stuff. Vertical action alive and well in corn. All right, Carley, that music means we've come to the end of our sojourn through the world of futures options. At least for this week, did a lot of living, did some energy, did some equities, did some shiny stuff, and we wrapped it up with a little bit of corn. And if folks are intrigued about any of these complexes we talked about, maybe some of the levels you talked about, or maybe they want to contact you about something else entirely, where should they go? What should they do?
Sure. So we offer 2 primary services. We are a futures and options brokerage, a boutique brokerage. You can check us out there at decarleytrading.com. And if you're just interested in market analysis, charts, commentary, You can catch us on Twitter at Carley Garner, but you also should consider our Substack page, which we offer all of our newsletter and commentary. It's carleytrading.substack.com.
There you go. Check her out along with all the other cool kids hanging out on Substack these days. And of course, if you want to check out our report, cmegroup.com/twifo, TWIFO /TWIO should also work. Get you to all these reports. And remember, these are running all the time, 24/7. So if you want to check soybean meal at 2 a.m. on Saturday, we're not going to judge. It's all there waiting for you, cmegroup.com/twifo. That's going to do it for us on the old Twifo. Back again after the closing bell today to break down what's shaping up to be a pretty wild day in the options market on the hot options report. Then we're back again tomorrow. Should be a banger talking on volatility views. I'll be joined by Dr. Vix and other sundry guests to break down the week that was and indeed still is on the vol side. And then, of course, we'll wrap it up for our pro friends, talking some weird and wild trades on options oddities. And we're back again next week, all the way through to next Thursday. Another episode of This Week in Futures Options. Stay safe out there, everybody.
This Week in Futures Options is brought to you by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world manage risks and seize opportunities. CME Group offers the deepest and most liquid options on futures across all asset classes, including interest rates, equity indexes, foreign exchange, energy, agriculture, and metals. For more information and educational resources about futures options at CME Group, visit cmegroup.com/options. This broadcast is intended for informational and educational purposes only and does not constitute trading advice or the solicitation of purchases or sale of any futures or options. The rulebook of the applicable exchange should be consulted as the authoritative source on all current contract specifications. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.